Welcome back. Last time we talked about why depression is not due to a chemical imbalance, but due to an economic imbalance. So today, let's get into how this economic imbalance occurred. Because it didn't happen by accident. It happened because of a series of policy decisions. To explain this, we need to turn back the clock to 1945. As World War II came to a close, it left the United States in an extremely unique economic situation. Most developed countries had been devastated by the war, but the US mainland was untouched. And it already had a booming wartime manufacturing industry. All the US had to do was to pivot from making weapons to making consumer goods, and it effectively had a manufacturing monopoly for the next 20 years. On top of this, the policy environment was very friendly toward working class people. Workers enjoyed strong union membership, taxes were progressive, meaning that wealthy elites paid more and working people paid less, and wages kept pace with productivity. A single income could support a family. The government also implemented strong social safety nets to help people who fell on hard times. This financial security meant people were generally content and optimistic. This period was really the high watermark for living standards in the US. And on a side note, this was also a period of high, sustained GDP growth, which shows that with the right policies, high taxes on incomes and corporations can coexist with high growth and high living standards. Now, things started getting rocky in the 1970s. The main reason was a series of political crises in the Middle East that led to dramatic spikes in oil prices. The US was extremely dependent on foreign oil at that time, and because the entire US economy relied on transporting goods and equipment using gas-powered vehicles, a spike in oil prices meant inflation everywhere. On top of this, we were now 25 years post-World War II, and most developed countries had rebuilt their industrial sectors. This meant the US now had to compete with other countries on international trade. Competition drove prices down and made it harder for companies to give raises without cutting into profits. High inflation from the oil crisis and low wage growth from global competition is what economists call stagflation. Now remember, this was still a time of strong union membership. That's extremely relevant because unions typically baked cost of living increases into their contracts. So when companies raised prices to compensate for rising oil costs, this created inflation, which triggered cost of living adjustments, which forced companies to increase wages, which pushed prices higher again. This feedback loop is what economists call a wage price spiral. Prices went up because of oil, then wages went up because prices went up, and this back and forth is what creates the spiral. So around 1979, a new narrative started to take hold. One that blamed unions for inflation. But remember, the extreme levels of inflation, above 10%, were caused by oil shocks. Only after that did union members push for wage increases. And if they didn't, their living standards would have collapsed. Starting in 1980, the US made a dramatic policy shift. Taxes on the wealthy were cut, industries were deregulated, companies began aggressively offshoring jobs. At the same time, the government weakened labor unions, making it harder for workers to negotiate for raises. What does this mean? Productivity kept rising, but the gains went almost exclusively to C-suite executives and shareholders. So what impact did this have on working Americans? Over the past 45 years, the cost of living rose while real wages stagnated. Take the federal minimum wage, for example. In 1980, it was $3.10 an hour. Adjusted for inflation, that's about $12 an hour in 2025 dollars. But the current minimum wage? $7.25. So the real value of the minimum wage in 2025 is a little more than half of what it was in 1980. The poorest Americans are worse off today than they were 45 years ago. Let's look at median household income. In 1981, it was $21,000. That's about $76,000 in 2025 dollars. The actual median household income today is around $85,000. That's a 12% increase. But does it feel like the median household is 12% better off now? Why not? Well, common inflation measurements compare wages to CPI, or the Consumer Price Index. CPI tracks things like bread, milk, toilet paper, and from 1980 to 2025, CPI rose about 293%. Groceries cost roughly 3 times what they used to. But CPI doesn't capture the biggest costs in people's lives. Cumulative inflation for housing is over 300%. For childcare, it's around 600%. For health insurance, it's over 650%. And for college tuition, it's over 1,200%. These changes happen slowly, so most people didn't notice that their living standards were eroding. The American dream didn't die suddenly. It bled out slowly over 45 years. What does all this mean for young people's mental health? Put yourself in their shoes. You're fresh out of school. Most entry-level jobs won't pay enough for you to live independently. The vast majority of young adults need at least one roommate or need to live with family, and even then, they face sky-high healthcare premiums, tens or hundreds of thousands of dollars in student loan debt, and an economy built on part-time, contract, and gig work, all to save on labor costs. And as we discussed before, young people who don't go to college are usually in an even worse financial position. All of this produces anxiety and depression. Financial stress is one of the strongest predictors of depression. Financial insecurity triples the risk of a major depressive episode. And how much have depression rates increased since 2000? Oh, that's right, they've tripled. Are you connecting the dots? Therapy can absolutely help people cope, but it can't repair economic conditions, and it can't fix the mental health epidemic. So now you know how policy changes created financial instability, but where is all that money going? In the next video, we'll follow the money, and we'll find out how wealth concentration at the top is driving despair at the bottom. That's all the time we have for our session today. I'll see you next week.